Hello, everyone. This is Rich Siegel and Carl Mariner with ARQ Wealth Advisors. Today is Monday, March 2nd, and with all the recent volatility and uncertainty in the markets, we thought it would be a great time to do a five-chart market update. The disclaimer language is right below there, so take a second to read that, and let's get after it. All right, chart one. The VIX, otherwise known as the fear indicator. This is a one-year chart, and you can see in the last few weeks, fear and volatility has been elevated. Carl, your thoughts?
Yeah, this is pretty interesting. We've highlighted here the long-term average volatility level, which is right around 18. And I think that's good context. And I think part of the takeaway is if we look over the past 12 months, there are meaningful spikes above 18. And the point that I would make is volatility is the price of admission into markets. We expect it to be there. This big spike is Liberation Day. Sometimes we see more uncertainty around different events that introduce uncertainty in the markets. But the idea that volatility escalates is not an unknown to us. So seeing recent events where volatility is picking up, we view that sometimes as an opportunity in how we think about when and where we're deploying capital.
Mm-hmm. Yeah, just to add on to that, from a math standpoint, a VIX of 16 basically it extrapolates out to about a 1% move in points per day in the market. So with the Dow at 50,000, a 1% move is 500 points a day. So we're at 21, which means you could expect somewhere between 600 and 700 point swings per day. And when things get high, like what Carl said back in like Liberation Day, when the VIX was like 50, that's like a 3% move per day. And that's really when you want to kind of back up the truck and get more aggressive when you see significant volatility spikes. All right, next slide. Market reactions to global conflict. Let's just move all the way to the right side of the bar chart. And what you'll notice is going back 100 years, the orange bar says 17%. That's the volatility of the S&P 500. That's about normal volatility. And the return about 10%. What's striking to me is during all these major wars, World War II, Korea, Vietnam, returns were actually pretty good and volatility was rather tempered. And then in the Gulf War and Iraq War, you could see volatility was higher. Your thoughts, Carl?
Yeah, we tried to put a little more context to this with the data down below. And one of the things that I would take away is that each conflict is a bit unique. There are
Mm-hmm.
periods where we see negative returns in the following year. I think one of the interesting takeaways is that if we look at the timeline of those, the terrorist attacks in 2001, that correlated with the tech bubble imploding. The
Right.
2022 Russia invades Ukraine time period really correlated with the equity market sell-off, the bond market sell-off that was happening as we were battling inflation. And so
Right.
in both of those cases, we saw negative, but not dramatically negative returns. In every other circumstance, we saw positive returns. And so the point that I would really make with this chart is that even in periods of geopolitical uncertainty or conflict, equity markets tend to be positive over time.
Agreed. Yeah, volatility creates opportunity, but these kind of tail risk events create a lot of unsettled behavior, and you see irrational things happen in the market, and then once the fundamentals start to weigh in, then things improve quite a bit. All right, next chart. Broadening markets. This is a fun one. We've been kind of relying on the Mag 7 mega cap tech companies to do most of the heavy lifting for the last several years in the S&P 500. And today, not quite the case. This is a year-to-date chart. Carl, you want to take it away?
Yeah, we've talked a lot about the need for building diversified portfolios and limiting the reliance on a handful of names. We've been pretty vocal. We think the Mag 7 are great companies, great businesses. They've delivered strong returns, but there are reasons that we want to minimize the size of those as names in the portfolios. If we're looking at the green line year to date, the S&P 500 is up about 0.5%, so basically flat. The Mag 7 is down 7% so far this year. Small cap stocks up 6%. international stocks almost 11% to the positive. So that looks great for us in the way that we think about building more diversified portfolios, limiting the reliance on a handful of names.
We spoke about the outperformance over the last several months of the foreign markets. Based on a weakening dollar and cheaper valuations overseas, we think the foreign markets could outperform for quite some time on a go-forward basis. We're excited about it.
Yeah, we still see US dollar valuations at pretty elevated levels. Those tend to move in very long multi-year cycles. So expecting that to continue to be a tailwind.
Right.
Rich, we've talked a lot about valuation. It's been a big theme for a number of years. We're seeing some rotation happening there. Tell us the story.
What a difference a couple of years makes, huh? This chart uses the term armies and bullets, and army, and this is wartime vernacular. So armies meaning the standard bearer mega cap tech companies like Microsoft, Google, Amazon. What's striking, really, going back 3 years, look at 2023, 2024, the dark blue chart. Valuations of these companies were really getting scary high, but earnings have been so strong, right? The P has been going up, but the E's been going up even more. So today, the price to earnings ratio on a forward basis of these big companies, without Tesla, because it's so volatile and unpredictable, is under 24 times earnings. That's not a heavy price to pay for that type of revenue um, and earnings growth. What's really striking is the fact that these bullets, let's call them the consumer staples companies like Costco and Walmart, they are trading at higher valuations than Microsoft and Apple and Amazon. So things have really kind of rotated here. We were really nervous about uh, price action based on valuations for these tech companies. We're starting to rethink a little bit. Um, Earnings are forecasted to be up 25% this year for those companies. And as Carl showed you on the last slide, the the return is negative 6%. That's a gigantic dislocation. And we talked about maybe a Goldilocks scenario where these stocks are muted or flat for the year, maybe even down, but earnings keep going up. That's a great setup for future performance.
Absolutely. Last chart here, Rich. Tell us a little bit about how we're thinking about positioning equity portfolios as we move forward into the back half of the year.
Well, as we all know, there's no guarantees, and history is just for guidance and context. But this goes back 80 years, this chart. And what's really interesting is it's showing you that in year number two of presidential cycles, year two is the worst performing year out of all 4 years. 3.8% is the average return of the S&P in year two. Now, we just showed you a few moments ago, you could have a 3% return of the S&P and 10 plus or even more in foreign stocks or small cap stocks. So let's not throw in the towel just yet. But the point is, you have a seasonality issue here in year two, right? You see Q2, Q3, that's the summer and fall months right before midterm election cycles. Investors hate uncertainty, and midterm elections create lots of uncertainty. What's even more interesting is that once there is certainty, the election is over, regardless of the outcome. Q4 tends to be the best fourth quarter out of all 4 years of a cycle. So, kind of on a go forward basis, our plan is to use any potential volatility and market corrections, 5, 10, 15% drops to really kind of get more excited, maybe back up the truck and add more risk to client portfolios. Today, by design, we're a little bit conservative, we're a little light. We think the opportunity for Q4 and then into next year, look at year three, right? The third year is typically the best year of a presidential cycle. So for now, the game plan is be a little bit light, hold a little bit of cash, rely on bonds and low risk investments, and then kind of get more aggressive as opportunities present themselves. And we think we'll have an opportunity sometime this year.
Absolutely. With that, we want to say thank you. We'll talk to you all soon.
Thanks. Have a great day.